Ever wondered how one man turned a few $1,000s into billions? What if I told you that the secret isn't in the stock picks, but in the strategy? Curious? Let's dive into the mind of Warren Buffett. Warren Buffett, often referred to as the Oracle of Omaha, is not just a name. He's an institution in the world of investing. But what makes his investment strategy so unique and successful? Value investing, the art of buying a dollar for 50 cents. Value investing is a concept that seems almost too good to be true. Imagine walking into a store and finding a product worth $100, but it's on sale for just $50. You'd grab it in a heartbeat, right? That's precisely the essence of value investing, a strategy that Warren Buffett swears by. At its core, value investing is about identifying and investing in companies that are undervalued by the market. These are businesses whose stock prices don't reflect their intrinsic value. But how does one determine this intrinsic value? It's a combination of studying a company's fundamentals, like its earnings, dividends, and overall financial health, and then comparing it to its current market price. But here's the catch. Just because a stock is cheap doesn't mean it's a good buy. This is where Buffett's genius comes into play. He doesn't just look for undervalued stocks. He looks for undervalued companies with solid growth potential and strong management. It's like finding a diamond in the rough and then patiently waiting for the market to recognize its true value. In essence, value investing is not just about buying stocks, it's about buying businesses. And when you think like an owner rather than a trader, you're already on the path that Buffett champions. So, the next time you come across a stock, ask yourself, is this a bargain I can't resist? If the fundamentals align, you might just have found your golden ticket. Long-term vision, the marathon of investing. In an age of instant gratification, where quick returns and rapid turnarounds dominate the investment landscape, Warren Buffett's approach stands out like a beacon of patience. His philosophy? Investing is a marathon, not a sprint. It's about the long game, not the immediate gains. Buffett's long-term vision is rooted in a simple yet profound belief. Good businesses will grow and prosper over time. While market fluctuations are inevitable, and stocks may dip or surge based on temporary factors, the intrinsic value of a solid company will only appreciate in the long run. This perspective requires an unwavering faith in one's investment choices and the discipline to resist the allure of short-term profits. But why is this long-term approach so crucial? For one, it allows investors to benefit from the magic of compounding, where returns are reinvested to generate their own earnings. Over time, this snowball effect can lead to exponential growth. Furthermore, a long-term vision shields investors from the emotional roller coaster of the stock market. Instead of reacting to daily market news or getting swayed by temporary downturns, they remain focused on the bigger picture. Buffett once remarked, "If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes." It's a testament to his conviction that true wealth is built over time, brick by brick, with patience and foresight. So, as you navigate the investment world, ask yourself, are you in it for the sprint or the marathon? Understanding your investments, the Buffett blueprint. Navigating the vast ocean of investment opportunities can be daunting. With countless industries, technologies, and trends vying for attention, how does one decide where to place their bets? Warren Buffett's advice is disarmingly simple: stick to what you know. This principle of investing within one's circle of competence is a cornerstone of Buffett's strategy. It's not about having expertise in every sector. It's about recognizing the boundaries of one's knowledge and operating within them. By focusing on industries and businesses he understands, Buffett minimizes risks and makes informed decisions. But why is this approach so effective? For starters, when you understand a business, you can better predict its future performance. You're aware of the industry trends, the challenges, and the growth drivers. This knowledge equips you to discern between temporary setbacks and fundamental issues. Moreover, investing in what you understand brings a sense of confidence. It shields you from the whims of market speculation and the fear of missing out on the next big thing. Instead of chasing every shiny opportunity, you remain grounded in your convictions. Buffett's success is a testament to the power of informed investing. It's a reminder that in the complex world of stocks and shares, sometimes the best strategy is to keep it simple. After all, as Buffett often says, risk comes from not knowing what you're doing. So, the next time you're evaluating an investment, ask yourself, do I truly understand this business? If the answer is yes, you're already on the right track. Economic moats, Buffett's castle of competitive advantage. In medieval times, castles were surrounded by moats to protect them from invaders. These water-filled trenches served as the first line of defense, ensuring the castle's longevity and dominance. In the world of investing, Warren Buffett coined the term economic moat to describe a similar protective barrier, but for businesses. An economic moat refers to a company's sustained competitive advantage that shields it from competitors. Just as a moat prevents adversaries from attacking a castle, an economic moat ensures that a business remains profitable and dominant in its industry, warding off potential threats. But what constitutes an economic moat? It could be a strong brand reputation, like Coca-Cola's iconic status. It might be patents and proprietary technology that others can't replicate. It could be a vast distribution network, economies of scale, or even regulatory advantages. Essentially, it's any unique feature or set of features that sets a company apart and makes it difficult for competitors to catch up. Buffett's emphasis on investing in companies with robust economic moats stems from a simple belief: businesses that can fend off competition are more likely to succeed in the long run. They can maintain or increase their market share, ensuring steady revenue streams and growth. In essence, an economic moat isn't just a competitive advantage, it's a fortress of sustainability. As you evaluate potential investments, consider this: does the company have a moat wide and deep enough to stand the test of time? If so, it might just be a Buffett-worthy investment. Fear and greed. Navigating the emotional tides of investing. The stock market is not just a playground of numbers, it's a theater of emotions. Two of the most powerful players on this stage are fear and greed. Warren Buffett, with his astute understanding of market psychology, encapsulated this dynamic in his famous adage, "Be fearful when others are greedy and greedy when others are fearful." But what does this really mean? At its core, Buffett's advice is a call for contrarian thinking. When the market is booming, and everyone is buying in a frenzy, driven by greed, it's often a sign of overvaluation. Prices are high, and the risk of a bubble is real. This is the time to exercise caution, to be fearful. Conversely, when the market is plummeting, and panic selling ensues, driven by fear, many stocks become undervalued. They're sold off not because of poor fundamentals, but because of widespread pessimism. This is the opportune moment to be greedy, to buy quality stocks at discounted prices. Buffett's philosophy underscores the importance of emotional intelligence in investing. It's about staying calm, rational, and discerning amidst the tumultuous waves of market sentiment. By not getting swept up in the collective euphoria or despair, investors can make clearer, more informed decisions. In essence, mastering the interplay of fear and greed is not just about financial acumen, it's about emotional resilience. And in the volatile world of investing, sometimes the best strategy is to listen to your head, not your heart. The power of compound interest, Buffett's eighth wonder of the world. Albert Einstein once famously remarked that compound interest is the eighth wonder of the world. Warren Buffett, a staunch advocate of this financial principle, has harnessed its magic to amass unparalleled wealth over the decades. But what makes compound interest so special? And why is it central to Buffett's investment philosophy? Compound interest is the process where interest on your investment earns interest itself. It's not just growth on the principal amount but growth upon growth. Over time, this results in an exponential increase in your investment's value. The key ingredient? Time. The longer you let your investment grow, the more pronounced the compounding effect becomes. Buffett's investment approach aligns perfectly with this principle. He's not a trader, hopping in and out of stocks. Instead, he's a long-term investor, allowing his investments to grow and benefit from compounding over decades. This patience and foresight have been instrumental in turning modest initial investments into billions. For everyday investors, the lesson is clear: start early, be patient, and let the power of compound interest work its magic. It's not about timing the market, but time in the market. As Buffett often emphasizes, it's not about being right, but being consistently not wrong. And with compound interest as your ally, the journey to financial prosperity becomes not just a possibility, but a probability. Curious to dive even deeper into the world of Warren Buffett? Don't miss out. Click right here to watch our next video about the legendary Oracle of Omaha. Trust me, you won't want to miss it.